want to see my broker, find out what he can do, 'cause I'm in the market for you.
Welcome to Stock Talk Happy Hour, where we have casual conversations about stocks, the market, and trading with other traders.
You're going up, up, up in my estimation. I want 1,000 shares of your career.
We're happy to have Carl Jorgenson as today's guest trader.
The hugs and kisses when dividends are due, 'cause I'm in the market for you.
Hi everyone, and welcome to Stock Talk Happy Hour. Today's guest trader is Carl Jorgenson, and we are so happy to have you, Carl. Thanks for being on the show.
Thanks for inviting me, Heather. It's nice to be here.
Yeah, we've been trying to get you on for a while. Our paths or just schedules just haven't synced up right, have they?
Well, that's okay. Persistence matters.
Yeah, it does. Let's dive right in. So, Carl, you got a lot of experience trading. Could you tell us a little bit about your trading history and how you came up?
Basically, I got interested in the markets back in about 1995, and one of the financial advisors I had spoken to at the time had recommended I study and learn something about options, so I began doing so. That year and the following years, I began dabbling in the markets. At the time, I was working full-time at a company as an executive. That company went public, and I, in essence, had a very concentrated position, having incentive shares, and I looked into ways to take the handcuffs off, meaning as an insider, I had a lot of limitations of what I could and could not do. And I studied and found some methods I could use and did so. And that involved option selling. And I got involved with that in the late 90s and did very well. In fact, it did well enough for me to decide in 2002 to begin trading full time.
Yes, weren't you a floor trader?
Yes, actually, I think it was in 2003 or 2004, I had an opportunity to get registered at the Pacific Coast Options Exchange in San Francisco. Once I became registered, that gave me some opportunities to be much more active, and it reduced costs since I was trading full time. And I also was a member of a prop firm or a proprietary trading firm that also allowed me to have some advantages that the typical retail trader does not have. I did that primarily to learn from the seasoned professionals that had been there and survived and done well for 20 years or more.
What a great opportunity that was.
It definitely was, and it helped me see and understand order flow, the market maker's role, how options really worked from the inside out and backwards. I still went on to make lots of mistakes, but I learned a lot. And that's, I think we all have that in common.
Yes, I think every trader who has any kind of longevity has survived a lot of mistakes. I know I have.
But those are valuable lessons, and sometimes the most valuable lessons are the hardest ones to learn, but the key is not forgetting them and improving from them.
Exactly.
Once I started actually achieving fairly consistent performance was about 2004, 2005. At the time, I was involved with several local trading groups because that challenged me to even learn more, volunteering to share what I've learned. And
what do you think the key catalyst was for helping you transition to a consistently profitable or successful trader?
Well, if you had to boil it down to one word, it was really discipline. Taking a systematic approach. You know, when you're in the early phase of learning, you're kind of eagerly consuming everything you get your hands on, or trying every new flavor that comes along, you know.
Yeah.
After a while, you find out what you like. You know, I've actually probably had some great trading systems that I had tried, but I gave up on them way too early and without fully understanding their pros and cons. And I think being successful isn't about having a magical trading system, but you could become very consistent and successful even with a crummy system, because it's the consistent application of a crummy system that will point out very quickly what's wrong with it, and you can fix that. In fact, if someone gave me a system that lost every time, that's a fantastic opportunity for me to take the other side of every one of those trades.
Van Tharp even did a study where he had no real entry signal or setup. He just entered randomly, and through good money management, he was able to be profitable.
It's kind of counterintuitive, and I know a lot of the industry focuses on other things, and there's lots of people selling hope out there. And
there sure is.
It's really very simple, but it's not easy.
I noticed you have a quote here from Mark Douglas.
Yes, from his book, I think, Trading in the Zone. Really simple but profound is, as a trader, we're dealing with this paradox all the time, because with each new trade, there's no way of knowing whether that trade's going to be a winner or loser. However, over time and with persistent and consistent discipline of your systematic approach, you can see a very consistent performance from year to year with a statistically meaningful, large enough sample. And it comes back to what we were mentioning about consistency or discipline.
A lot of traders fall short in executing consistently and having a repeatable process. And I think that's where the discipline comes in, is you have a process, you execute it consistently, repeatedly, over and over, and then you're able to improve upon it. You're able to see where the setups are weak, where they're strong. You can start to make adjustments. You can't do that if you're changing your approach every 5 minutes and shifting strategy to strategy.
Exactly. If you're bouncing around from one idea to another, you'll never know whether is it you or is it the system or methodology. You have to stick it out long enough to figure it out.
Exactly.
One of the things that I had to learn, and it took a while to learn, is really focus on those decisions that I can and do have control over. There's so much that goes on in the market that you have no control over. I don't think any of us are big enough to move the market per se.
No.
But there are those who do, you know.
Right.
So,
they're not in our little chat room.
so it comes down to really focusing on those decisions you do get to make. And here's kind of how I look at it. I tend to overly simplify things, but it really helps me stay focused as a result.
I love streamlining everything, and I just want to boil everything down to its simplest, most robust essence.
Then you can really focus on them and improve. I know some people may use the word investor, and I think that's just a longer term trade. You know, you still need to decide what to trade. You need to decide, when am I going to get into this position? You need to decide, when am I going to get out? And you need to decide how much or how big of a size am I going to take? How big is my position? And, you know, if you really boil it down, it really kind of comes down to those 4 decisions that you're making on each trade or each position.
It doesn't matter whether you're day, swing, or position trading. You still have to answer all these questions. You know, what to trade, when to get in and out, and how much are you going to buy? So
much of the media, the publications is so focused on questions 1 and 2 on the screen of, you know, here's a hot tip of what stock's hot right now, or you should be buying this. And unfortunately, some talking heads have their own agenda or positions that they're trying to manipulate the market and create supply or demand for. And you got to realize it and understand to ignore those that have vested interest in the comments they make.
Absolutely. And really, exits are how you make your money. They're one of the most important things in trading is when you exit and how you exit.
Both Van Tharp did a lot of studies in this, as you mentioned, as has Chuck LeBeau, where he asked the question, which one of these 4 aspects are the most important? And when you kind of do some random studies, and I didn't believe this at first, but question 4 is the most important. The good news is there's some very simple methods, and once you really fully understand risk management and position sizing, really your number 4 is very easy to deal with, but you can't ignore it. It arguably is the most important of these 4 decisions. The second most important is really the exit, when to get out, or question 3. This too, I in my early part of my career thought, Just question 2 is the most important, when to get in. If I time my entry good, then the exit's easy, right? Well, it's actually opposite of what you think, and what too much of the media's hype is focused on. Is it's really exits, and item 3 and 4 are really tied together, because
I agree.
how much you can make and how much you can lose is a product of the mathematical multiplication of the number of shares times where was your stop when you're wrong, or what was your exit methodology when you have a winner.
That's right, and it goes back to what we were saying earlier, is we don't know what's going to happen. So position size wise, we have to be able to survive all the drawdowns to the losing trades so that we can stay in the game.
Chuck has probably done more analysis than a lot of people on this aspect of exits. His testing, as well as Van Tharp and others, have shown that if you randomly pick a stock and randomly pick when you enter, but manage your exits, you can have a profitable system even with a random method. I don't recommend that, but it shows that the exits are more important. Maybe many years ago, when the Wall Street Journal did a competition between the chimpanzees and the brokers, they kind of canceled that embarrassing test. They didn't look too good when the monkeys beat them.
Right.
And why did the monkeys beat them? Well, the experiment was flawed. They inadvertently had applied a methodical, consistent system with the monkeys exiting their positions, because that wasn't part of what they think they were testing. Anyhow, so that kind of takes us to really understanding your beliefs. I didn't believe that the exits were more important than entries until I did my own random number study, and I go, gee, these guys are right. I had to change my beliefs.
I think it's always good to challenge your beliefs. A lot of traders, they just take for granted or accept what they're told or what they read, and they never really bother to check it out for themselves. And that's where the real learning comes in. And that's where you can really start to take a strategy and make it your own, not because somebody told you it works, but because you're testing it.
That's painfully true. I read one of Van Tharp's books, I think Trade Your Way to Financial Freedom, probably in the late 90s or something. And when I read it, I kind of agreed with the beliefs and concepts in the book. But I went on to make those same mistakes that I knew better. And when I read the book the second time, a couple years later, it had a profound impact, because I realized those things really are true, and they really are more important than I gave them credit for.
But one of the things that Van Tharp, I think, is pretty well known for is he basically said, we don't trade the markets, we trade our beliefs about the markets. And that's why I think it's so important that we challenge our beliefs. One belief I came up with was that you can't make money trading cheap stocks, cheap being under $30. But that's not true. You can make a tremendous amount of money. And Jesse Stein, who wrote Insider Buy, which is a great book, he's made a fortune trading lower price stocks. But he has discipline, he controls his risk, and he controls his position size, and he has methodical process that's repeatable.
I hear the myths all the time about, oh, you can't make money buying options. Well, I've done quite well, thank you, for 10 years. Put a couple kids through private university, and it's too risky trading options. Again, well, everything's risky especially when you don't understand the risks. There's a lot of unhealthy myths out there.
Oh my goodness, you have that very quote that I just said. How funny.
Yes. A lot of this gets back focused to what some people call the golden rule of trading, or cut your losses short and let your winners run. Well, that's a really easy thing to say. I agreed with that when I read it. But boy, there's a lot more to it to actually implement that.
Trading is simple, but it's hard.
Yes. Remember, step one, the first half of the golden rule is cut your losses short, meaning don't let a loser turn into a big loser, is what that means.
Right.
That's the most important lesson if you had to slice this into two pieces.
It really is. And I can honestly say that as I've progressed, I have made that mistake. I've let a few big losers get out of control, and they were hard lessons to learn.
Oh, and I have some scars as well too that hurt when I think about them. But I'm very thankful I learned that really early, because when the markets turned on me and I did very well in the late 90s and I did not do so well in 2001, 2002, thankfully I learned this enough where I didn't let my losses, I got the cash, I got out of the markets. I was very diversified according to what the financial planners I've spoken to. But it didn't matter. Everything went down, right?
Right.
So what? Thankfully, I got out with reasonable losses or small losses that were very recoverable. And I realized I had a lot more to learn during that time. And that's when I was studying the markets and learning.
Well, you suffered enough pain early on that you were able to keep yourself in check.
Yeah. And now the funny thing now is I'm really a bear at heart, meaning I love bearish markets.
I do too. I loved a short.
You can make a lot of money real fast in bearish markets, but that's another story. The important point here, and you kind of already made it for me earlier, was if you can keep your losses small, then you can survive long enough to learn what you need to change or do to improve and learn from your experiences. If you don't do that, you may blow out your account before you can ever learn the second half of that lesson of letting your winners run.
Right.
And I'm embarrassed, but it took me a couple of years to get from the first half to the second half of this lesson. But if you looked at my equity curve, you would see I was profitable, but the angle definitely accelerated once I learned lesson 2 and applied it consistently.
You know, I agree with you that you really need that 1-2 punch. You need to control your losses and you need to let the winners run. I know so many traders that they might be able to do one, but they can't do the other. I personally know traders who can keep their losses small, but then they choke the winning trade and they never get any traction.
And that was me for a couple of years. Is a trade goes your way and you just become more and more anxious to book the profits. Mm-hmm. And that was my mistake. And this takes us to another myth. I don't have a slide, but I hear this all the time. People say, oh, you can't go broke booking a profit.
You certainly can.
Absolutely, you can. and if you have 10 losers in a row of just, let's say, $100 each, and you have one winner, well, it's got to make at least $900 plus to break even. Well,
That's right.
If you only let it make $500, you book the $500 profit, you're still net loss. So, yes, you can go broke taking a profit.
You can. The most important thing that a lot of traders can't seem to wrap their mind around is that it's your average win-loss ratio and then your win ratio that determine everything. You can have set up or a strategy that only wins 30% of the time, but if you're losing 1 and winning 6, you're going to make money.
Yeah, and even if you only have one winner out of 10 trades, if that winner's big enough, you can still be profitable. The problem is very psychological. Or how tough is it to keep taking your system when 90% are losers? That's a real tough one to stick to.
It is.
It's possible, but it's very tough.
Well, if you have a system that has a 30% win rate, and hypothetically speaking, you should be psychologically prepared to lose 7 trades in a row. And that would fall within a normal parameter of that strategy.
Amateur way of thinking is, well, if I trade bigger size, I can make more money. And that's mathematically true. The problem is when you're mentally focused on profit, you're going to subconsciously ignore data that's telling you you're wrong because you're looking to be right. Truth is that the professional traders have learned that lesson the hard way. What you have to really focus on first is what can I lose?
Personally, my trading improved once I shifted my focus from reward onto risk. Everything I do now, risk is in the forefront of all my decision making.
And that's so important. And this goes back to the golden rule where you've got to learn lesson 1 first of how to keep your losers small, but you also need to learn lesson 2 of letting the winners run so the net is profitable. And that's the simple truth of what it takes. There's a lot of great quotes from Jack Schwagert's series on the New Market Wizards. What's interesting of that series of books is, though the various traders that Jack interviewed were very diverse in their methodology, they all had some of these same key lessons that were important for their success that we are sharing. I read those books back 13, 14 years ago, and I still had to learn the lessons the hard way. Maybe I'm just slow at learning, but
No,
boy,
you're not. I
they
read
sure mean a lot more when you've felt it yourself, you know?
I've read all those books too, and I thought that I didn't have to learn the hard way, but I did.
Yeah.
A lot of
And
people
then,
who think they're really smart, or
and then
people who have done well in their private lives, often tend to make the most mistakes because they're used to doing well and they're used to using their logic to figure things out, and the market isn't logical. You're dealing with a situation or a context where you have uncertainty, and
yeah, there are unknowns, and the distribution of winners and losers, and you've got to learn to manage both. You know,
exactly. Uh-oh, this looks like Ed
our
Sakota.
good buddy Ed, one of those wizards that was written up in Jack's books, he sums it up better than anyone else with his 6 points, kind of saying the same thing: ride your winners, cut your losers, manage your risk, use stops, and really items 3 and 4 are really talking about how to implement item 2, right? And stick to your system that's being consistent, and file the news. That's a real important one. File the news means ignore the talking heads, you know.
It's just
Um,
noise. It's just
well,
noise.
and there's an agenda out there. If you've read Reminiscence of a Stock Operator, you'll see that this human behavior goes back more than 100 years. Or if you remember just this last year when Oprah Winfrey announced her support with Weight Watchers, well, go back and look at the volume on Weight Watchers in the preceding 3 months. You'll see the first week something abnormal each time in each of those 3 months. I'm not saying that that means anything, but people making public announcements are how markets are manipulated. And file the news is very important because you don't want to be the sucker that's taken the bait.
That's right. I think one of the challenges a lot of traders face is whether it's a system or a strategy or what the market's doing that day or news, is separating the noise from the signal. And I think anything that a trader can do to simplify and reduce the amount of noise will improve their trading.
Oh, absolutely. It's funny you say that. I did not prepare a slide on that, but maybe it's coming from a technical and engineering background. But I've done a lot of signal to noise studies on the markets, and a very important principle that I learned from that exercise was the shorter your time frame, the higher the noise. I day traded the futures for about 5-6 years, very high intensity level. I did very well. I was in the minority. A lot of people lose their shirts fast because when you're dealing with leverage in the futures, you can make a lot of money real fast, and you can lose a lot of money real fast. And it just amplifies what we've spoken about already, how much more important it is to have discipline and keeping your losers small and letting your winners run when you're trading a highly leveraged instrument. Those disciplines are multiplied by their importance.
I forgot to mention there is actually a book by Nate Silver called The Signal and the Noise: Why So Many Predictions Fail but Some Don't. It's a wonderful book, and I highly encourage anybody who's interested in signal and noise to read it.
I'm a technical trader. We're going to talk about that in a minute, but I use Wells Wilder's average true range all the time as a measure of that noise to say how wide does this particular stock swing on the typical day. Yeah.
I also use the average true range. I use average true range statistics over 30 days, and it's amazing how often a stock will start to find resistance or support at those levels.
Even if you don't read all the books, you read the last chapter to get all the key points. Not that I'm lazy. I've read the entire books. But the last chapter is where Jack summarized kind of like what was common amongst the traders he spoke to. And if you're not familiar with the books, Jack really comes from more of a journalist background, and he had a process where he selected candidate traders to interview based on a 9-year consistent profitable performance. And he hired an accounting firm to confirm the brokerage statements. So the people interviewed in there truly are consistent performers, though their trading styles are dramatically different from each other. What were the important lessons they learned to achieve consistency, to achieve success? That's very valuable. And I've given us a few points here already, and we've kind of talked about all of them almost already. So I will share the slides so people can go back and take a look at them, but we'll move right along and get into how do we implement these things we talked about. Well, we are going to switch now kind of into technical analysis. And again, being one who kind of overly simplifies things, I look at technical analysis this way: is it's a very objective study of raw data of price, time, and volume from actual transactions or trades in the markets. It's the raw data that pretty much all technical analysis is built upon. But one of the common misunderstandings is technical analysis does not in any way predict the markets. I know human behavior is such that we hope and wish it could, but it does not. What it does do, it reveals those behaviors of the market participants. Specifically, the markets are made of people. There's buyers and sellers. Whether they're big or small traders, it doesn't matter. A buyer and a seller has to agree on price, but they generally disagree on future value of that asset, and that makes a market.
I think of charts as insight into the psychology of the crowd, not necessarily prediction.
Yeah, very much so. And that's enough to give us an edge. And we're going to talk a kind of example of that in a moment here. Certainly, I've put a lot of my study and effort on the technical side and have been an active member in both the Market Technicians Association and in the Technical Securities Analyst Association. I started off using a lot of fundamental data, but I found that it tended to be a little late. I mean, I've been on both sides of the desk where, as a public company, you have quarterly earnings reports and you work hard to meet your objectives and expectations, and the data is made public, and that's all good. But there's a little bit of a lag there, and as I became more and more active, I wanted as fresh a data as I could get, and minus all the interpretation, because even with fundamental analysis, although it's extremely objective, it's based on financial performance and standardized reporting methods in the accounting industry for companies. There's still subjective room for interpretation, and when we get into multiples and what kind of multiples should be expected for this business sector, that gets very subjective.
Most traders I know evolve more into technical analysis as their careers progress.
Yeah, I don't want the listeners to take it wrong. I'm not putting down fundamental analysis at all. I think it's very important, and it reveals whether a company's healthy and growing or not. But in my trading decisions, I've chosen to really focus on the technical side. And the next slide, I'm going to talk about some of my beliefs. You don't have to agree with these, and I don't expect you to agree with them, but they're my beliefs of how I look at technical analysis and how I use it in my trading decisions. So the first one we already started talking about a little bit, where humans have a tendencies of repeating similar behaviors when making financial decisions. And the whole field of behavioral finance studies that very phenomena. The net tendencies of the market's participants, all the people who are buying and selling, get reflected in the actual price, time, and volume of the transactions they make, regardless of why they're making those decisions. It's kind of impossible to answer the question why. It took me a while to finally let go of the desire to answer that, because it's impossible to know what was in the mind of every participant. And why did you buy? Why did you sell?
And it doesn't really matter why they bought it. All that matters is the final result manifested as price and volume.
So we intentionally kind of ignore the why. I'm not saying it's not important, but again, for a tool to help us make objective decisions, we choose to kind of ignore the why and the subjective side of that. The second belief is when you study all the patterns and indicators, I've come to my own conclusion, and I don't expect anyone else to believe this, but I'm sharing what my beliefs are, is that continuation patterns occur more often than reversal patterns. Therefore, based on that, I intentionally have a bias. I intentionally require a bit more confirmation, signals, whatever, from the charts to tell me it's a reversal than I require for telling me it's a continuation pattern. So I have that bias built into my belief system and my trading rules. I recognize it's one of my beliefs. Thirdly, there is no such thing as a perfect system. And the nice thing about that is I don't need it to be perfect. I just need it to give me a statistical edge, one that I can take advantage of over time.
What? There's no holy grail?
I'm sorry to let you down. And now your listeners have been let down too. The only secret is the person in the mirror.
What's fantastic about this slide is that you've taken the time to investigate and know your beliefs and then structure some kind of a strategy or approach to how you trade based on them. It's conscious, whereas a lot of traders, they trade unconsciously. They don't know what they believe, they don't know what they feel, they don't know what they think. They're just jumping around in and out of trades. And knowing your beliefs, I believe, is an edge.
Oh yeah, it helps you focus your energy, time. We all have a very limited resource called time. So I want to spend my time in the most effective way, and this helps me do so. Again, these are my beliefs, and I think, like we mentioned the quote earlier with Van Tharp, all you can really do is trade your beliefs in the market. And I think Ed Seykota has a similar quote as well too. Yes, there are times where I objectively look at the evidence and it convinces me to change my beliefs. I try to come up with some very clear definitions, and I'm sure these are in most books about technical analysis, and probably most people have heard these before, but I consciously use them as reminders of this is or is not a signal to confirm a message from what I see in the charts. So a bull trend has both higher highs and higher lows. A bear trend has lower lows and lower highs. And when there's no trend, one way to describe that is it's range bound, or it's moving up and down in a narrow range or in a pattern, does not give us a clear signal of being a trend. And no trend is a very valid condition. In fact, markets can spend a fair bit of time in that.
And the S&P 500 did over the last couple of years.
Yes, very much. If you look at the longer term charts over the last year and a half, you could argue that we've been pretty much in a horizontal market.
And one of the things I also use when exploring whether or not we're in a range-bound situation is I look at net percent change over the time frame that's being looked at. It might go up and it might go down, but are we at about the same place we were 3 months ago? And if the answer is yes, then we're range-bound.
A very good test for that, exactly. Another important thing to understand, because I know this drives some people crazy, is it's certainly often true that you can have different trends when you look at different time frames.
Absolutely.
We talked about, like, if we look at weekly charts for the last year and a half, we see a mostly horizontal market. Whereas if you look at daily or hourly charts, there's definitely been times of accelerated violent moves up or down. You could have different answers of where are we now based on your time frame and understanding that, and that can be turned into an edge as well too.
And another edge regarding time frames is just simply knowing what time frame you tend to perform better at.
Right. We're going to talk about my style in a few minutes here, but I'm mainly a swing trader, and I'm mainly looking at daily charts. I occasionally and intentionally look at longer term charts to give me context. And I have a whole methodology I start each day with to kind of go through a process. The bottom line is I want to know the context that we're in as if it's a fresh look, and I haven't looked at the markets for days, weeks, or months, though I have. I want to come to it with a fresh palette each day. Let the charts tell me what's going on, and work hard at having a very objective eye in that process. Speaking about patterns, I'm going to share one of my favorites. There are many patterns, but this is one of my favorites, and I actually, when I was day trading the futures, I got very good at this because I could see market depth and other things that would tell me pretty much when it's going to break. But basically, there are variations of these two patterns. They might have 2 or 3 bumps, but basically, each one has its behavior. The one on the left, we see buyers are being very persistent to keep testing this line of resistance. And there's supply up there. You can imagine there's a bunch of orders from participants that want to sell, and eventually that gets consumed. Same thing with sellers. There's some demand or support. And what each of these patterns are telling us, on the left, it's a bullish pattern. It usually happens in a continuation. It can happen as a reversal as well, too. But what you see is persistence of the buyers continuing to test that same area. The sellers, on the other hand, are getting weaker and weaker after each retest. So the dips are consistently getting smaller, but the buyers are being very persistent to kind of nibble away at that resistance, and it eventually breaks. Likewise, but in reverse, the same happens with demand or support. Not always. It can fail. Both. It's not a prediction, but it's a high odds pattern. High enough odds for me to take advantage of it when I see it. And since Apple's earnings, we've seen this same pattern happen a couple times.
Well, in essence, these are ascending and descending triangles, are they not?
That's definitely one way to classify it. It also could almost be a cup and handle if you look at it as a reversal. These happen in all time frames, and they're quite common. No, it's not the only thing I look for. I know with Apple just a week ago, I saw it on the 15-minute chart, and I got all kind of warm and fuzzy inside to say, oh, I know this one.
I know that same feeling. When I look at certain charts, if it makes me catch my breath and my heart starts to pound a little quicker, I know that's a stock to put on my watch list.
Yeah. A warning is it's not about making emotional decisions, but it is human to have emotions. We're not machines.
I believe that we can use our emotions to our advantage. I think it's a great tool, and people like to dismiss intuition, but as human beings, we're able to assimilate and assess massive amounts of information. And when we look at a chart, the same thing can happen. If you have enough experience, your brain will recognize things that are setting up.
Yeah, and I think experience is the key word. I was very fortunate to learn the skill of tape reading when I was at the exchange. And I worked with a gentleman that had the skills and had used them for a number of years. There are messages that you can learn to recognize when you're reading the tape that you do not get in any chart. As a musician, you'd understand this because there's an aspect of rhythm and pattern.
And tempo.
Exactly. And the velocity of how quickly things accelerate or move, or how often they keep coming back to this level. So there are other bits of information and behavior that are seen in the tape, if you are fortunate to learn those skills, that really are not accurately reflected in the charts.
Just for some listeners who might not be familiar with reading the tape, we're talking about level 2 and time and sales.
Yeah, pretty much time and sales. So you need to have a service or access to the exchange, or your broker provides streaming of the time and sales data. And literally, you're watching each transaction pass your screen in a sequence of just simply 3 pieces of data: the price that it traded at, the number of shares it traded, and the date time stamp that transaction happened. Now, in a very active stock, that could go screaming past you. So you might do things to kind of only see the bigger trades or the net effect of trades. In a quieter stock, it's not as fast. It's the same data that technical analysis is based on. It's just you're letting your brain kind of recognize the patterns as opposed to software drawing it on a screen for you.
I know a lot of prop traders that use the level 2 and time and sales, but for me personally, I just like the time and sales. I feel that the less games are played, you get the truer picture by watching the tempo and the amount of orders that are going through.
Yeah, the other thing that I learned on the floor is to recognize the dance steps of the big players. I think there was a comment that came up yesterday in the chat room, and thanks for inviting me to the chat room.
Oh, it's great to have you, Carl.
I've only visited a couple days, but I'm impressed that you've got a pretty serious group of people that stay on topic and share useful bits of information. But,
and now we've got our option guru,
well,
which is you.
There are patterns or dance steps that if a large broker has a client that wants to buy 1 million shares of something over a course of a day or two for an average price of X or less, well, the broker's not going to put in a big order like that because he'll drive the price up. He's supposed to be buying 1 million shares, but he's actually going to start selling. He's going to sell a few shares to test the waters to see how is there demand to consume it or not. Because he's going to work at putting more demand, but he needs to know if he's competing with a bunch of other players or not. To overly simplify it, over the course of the day, he might be buying two, selling one, buying two, selling one, but whatever, all day long, so that over the course of the day, he's sold a lot, he's bought a lot, but on net, he's accumulated the million shares his client has asked him to do and has done it at a price at or below what his client has asked him to do. And the dance steps are just a way to manage the supply and demand behavior in the market so you are not becoming your own worst enemy of moving the market against yourself. When you watch the markets or see patterns on the charts, they kind of reveal themselves when you learn to recognize them. And someone had pointed out a chart yesterday. I looked at it. There was some abnormal volume, but the price was amazingly quiet. In fact, suspiciously quiet.
I was just going to say that I remember the volume had been up and the price hadn't done much. That's actually one of the things I look for in certain setups that I trade. I look for above average volume with very little price movement.
Now, what you don't know is, was that a big player accumulating or distributing?
Well, that's where the other elements of my setup help me.
Here's kind of my process. Well, how do I find my next trade? Well, this is a simplified version of it, where I'm going to look at the indexes, the major indexes, weekly and daily charts, pretty much each day. That's, in fact, usually what I do to start my day before the market's open. When I look at the bigger picture, which the weeklies are kind of my effort to do that, I see the context to remind myself, are we in a horizontal market? Are we in a trending market? What's the behavior? So I'm trying to intentionally start each day with a fresh, clean slate with no assumptions and let the charts tell me, yes, we're trending, we're bullish. More often will lead me to what are the key sectors I want to look at next. And then within those sectors, what are some key stocks I want to look at? I'm generally trading the most active stocks and ETFs are the majority of my trades. The bottom line is I have a process that's very top down, looking for opportunities, and an opportunity is a clear opportunity for a new trend is forming, a trend is changing. Briefly, I'm going to introduce options because that's primarily what I trade as well too. Options were designed for managing risk, and they're very good at that. Pretty much all the people who trade options are doing it for one of these three reasons. Either it's a hedging tool, meaning you're buying insurance, either on a stock or a large holding you have, or it could be your entire portfolio. You're buying puts to protect you from the downside of maybe the S&P index is the more correlated index, or maybe the NASDAQ is better correlated to your portfolio. So buying insurance or hedging is one of the primary uses of options. A second is becoming the insurance company who sells them. So there are many strategies using options that are collecting the premium each week or each month. And you're basically providing insurance or you're taking on the risk. Third is a speculator, and that's where you're using the leverage that options can provide to make, directional bets on the market. A direction is not just bullish and bearish, but it's also horizontal. That can be a speculation as well too.
So a lot of the options trading that you're going to talk about, people who trade stocks, they can apply the same things to their trading.
Yes. So the vast majority of my trading is I am a speculator. I take an opinion. Over 90% of the detailed steps of my trading methodology is just like I'm trading the stock, because the underlying stock is the most dominant aspect of what affects the price of the option contract.
I think a lot of times when stock traders hear the word options, their eyes glaze over and they kind of turn off, but this can be really valuable information that can help your trading.
Yeah, it's a very powerful tool. It it bothers me when people say options are very risky. Well, if you don't understand something, absolutely. So I encourage people to consider and learn about them. They may or may not be appropriate for you. They're certainly not appropriate for everybody. But understanding that there are other instruments out there and what they're good at, I'm going to share some pros and cons of options. A real simple example, but you'll see that for some things, options are not a very good choice. For other things, they're a very powerful choice. So.
Any strategy can be risky if you don't know what you're doing.
Exactly. Yeah, and futures really even greater leverage.
Right.
Trading stock without using margin is a one-to-one leverage. With options, I could typically have somewhere between 5 to 1 to 10 to 1 leverage. Futures might be as much as 100 to 150 to 1. So leverage works both ways, and you really need to understand and respect it and have the discipline in place first before you consider venturing into those areas.
I couldn't agree more, Carl.
Let's talk about some of the key differences between trading stock versus trading options. As a stock trader, you really are basing your decisions on one key opinion, and that's what do you think the future value of that stock might be. You have a bullish or bearish or neutral opinion about that stock and looking for an opportunity to profit from that. Options traders need to have that, and in addition, two additional opinions. One is about the time frame, meaning how soon might it get to that future value. Secondly is the implied volatility of the options. What are they now and what might they be in the future? The implied volatility is another very important variable that impacts the price of the options contracts. As a swing trader and as an options speculator, the two most important factors that affect the options value are the underlying stock and its price, and then the volatility. And I'm not talking about the stock price change, but I'm talking about the options price. How expensive is it or not? An example of implied volatility would be, let's say you're buying insurance for your home and your home is in Florida. If you want hurricane insurance, it might cost an extra $1,000 a year. On the other hand, you say, no, I don't think I need it. Hurricanes actually only hit my specific location once every 20 years. Well, a year later goes by, there's a hurricane that looks like it's about to hit your area tomorrow, and you call up your insurance broker and says, I've changed my mind. I want to buy insurance right now. Well, he'll sell it to you, but it's not going to be as cheap as it was a year ago. It's going to be real expensive. Why? Because the probabilities have changed, right? Similar with options. When the markets are crazy or quiet, the price for that insurance is cheap or expensive. Very important aspect of options that you need to understand and appreciate and implement in your trading strategy. So as a stock trader, we're kind of asking and forming an opinion about the market. Is it bullish or bearish or neutral? Now, as an options trader, we have to kind of multiply this instead of 3 choices into like 9 choices of, is the implied volatility of the options right now low or cheap options, or high and expensive options, or in between? This is a matter of looking at the implied volatility of that options chain for that underlying instrument, stock or ETF, and seeing what its range has been over the past year, to kind of determine I'm in the low quarter of where that value has been over the past year, or in the high part, or in the middle. And that changes a strategy of what I might want to do with options to take advantage of that market. Yes, there's a bit more involved. It's not complicated, but yeah, there's a couple more things to learn to do that effectively. Ultimately, we're going to ask ourselves the question of where are we now? Where do we think we're going? And it's that would point to us to what option strategy would be appropriate for that trade opportunity. Ultimately, and with experience, the best traders stay in the flow because they're not trying to force their opinion on the market. They're simply reacting to what's available, that the market's making available to us. And this quote from Mark Douglas, I think, says it better than I can. As you become more experienced, you kind of have more tools in the tool chest, and you can pick out the most efficient one based on what the markets are doing, as opposed to having one strategy and waiting for the right opportunity to show up.
I think ideally you want to be able to look at the markets without bias, but the fact is we all have emotions, we all have biases, we can't escape them. The best thing I think traders can do is just be aware of your bias. I have a bullish bias, and then go out of your way to take in, to look at, to investigate information that contradicts that bias so that you can have a more even view.
Yeah, what are the markets doing now, and does this represent an opportunity for my well-defined edge? If the answer is no, then I don't try to force a trade. I have the discipline to stick with it.
That's a sign of a seasoned trader, someone who has the discipline not to force a trade.
Yeah, there's plenty of days where I don't trade at all. Either I'm just managing my open positions, which takes almost little to no time, or I'm looking for opportunities and it's just not a good day, and that's fine. What tends to happen, regardless of what your criteria is, they tend to happen in clusters. When you start out, you really need to focus on one system and developing one system at a time, because the point is to get very good at it and know your edge inside out and backwards. Because over time, you'll develop multiple systems and you will know which one works better for what market types. It's like being the coach. And on the sidelines, you know, oh, we have this situation forming on the field. I'm going to send in these players because they're better at this situation. Same thing with trading systems. Over time, as you develop multiple, you can be the coach. I've already mentioned this in terms of an example of going through the process. Over the last 18 months, we've seen mostly horizontal market with several reasonable dips here and there. We've seen oil and steel that were mostly bears in all of 2015 and have been somewhat bulls so far this year. There's all kinds of political stuff going on. Having such low to no interest rates forces a lot of savers to look for some sort of returns in the market. So I think we have an oversupply of money looking for a place to go. That's an opinion. That's not a tradable comment, but that's a context. So let's talk about my specific styles. I have a retirement account that I mainly position trade, stocks and ETFs, occasionally options. It takes very little of my time. It might be anywhere from 2 or 3 to 5 or 10 trades a year. Most of my activity is swing trading. My swing trading style is very much a trend following style. I'm using options for the leverage, and I pretty much use technical patterns and indicators, mostly price patterns. Over 90% of my trades are on the top 20 most active stocks and ETFs. And that's a matter of efficiency and opportunity. Here's some statistics that have proven to me over the last 10 years of being pretty consistent with this swing trading style. I'll typically do about 100 trades a year. In the 100-120 range is pretty much where the average is. The win-loss ratio is pretty close to 50-50. There's some years where it's like 53 or 57% winners, but
a lot of people who might be new to trading may not realize it, but a 50% win rate is very good.
The winners average a plus 2.7 R. I'll talk about R in a moment. And the losers, if we take all the losers, they average a minus 0.8 R. So the point is the winners are bigger than the losers. And that goes to our prior slide of the golden rule of trading. Keep your losers small and let the winners run.
Here's a chart that I'm constantly showing to people about your win-loss, your percent of winners, about keeping your risk-reward ratio as high as possible, and what winning percent you would need to break even. So all the yellows are where you need to break even. I know from research that a lot of professional traders, even on Wall Street, don't have a 50% win rate. But what they do have is they have the really high average reward versus a very small loss.
Yeah. And it really goes back to what we talked about earlier, is first learning to really keep the losers small and never let one loser get away from you. If your account is down 50%, well, you got to make 100% just to get back to break even. The maximum, now I can certainly trade less than this, but the maximum risk per position can never be more than 2% of my current account value. That's true whether it's a stock trade or an options trade or any trade, futures trade, anything. I also have a portfolio risk rule of no more than 6%. So whether I have 3 or 5 or 10 open positions, the risk exposure of the initial risk can't add up to more than 6% of the account value. Well, at first, people who don't understand this might ask, well, how could you ever have more than 3 positions if you have a 2% rule? Well, if a position moves in my direction and my stops have been moved to, let's say, break even, then the initial risk dollars are no longer computed in this risk rule. I still have risk in the trade, risk of giving back my profits, but it's not any of the initial risk amount, if that makes sense.
Do you have a limit on how many open positions you will have?
Yes, and this might sound odd. I used to use a number. I no longer do that. I have a rule that I say, and it's written in my trading plan, is no more than I can accurately remember.
I like that. That's great.
Meaning, what happens if my computer crashes? If everything goes, down, no internet, whatever? If I can remember that, okay, I entered at this price, I have this many contracts of that, I have this, I have that, I have that. If I can remember them accurately in my mind, then I'm okay. If I can't, then I got too many. If I take all of my trades over a course of a year, the holding period average is about 5.5, 5.25 days.
Do you throw out the outliers when you're tallying that up, or is this the whole shebang?
Great question. I don't throw anything out. If I followed my rules for the selection, entry, exit, position, size, if I accurately followed my rules on each of those steps, I put a yes in that column, just a Y or an N. If all four columns have a yes, then that trade analysis goes into pile A, the first pile. If any one or more of those columns I answered no, to say I violated my risk rule on the exit. And this was one of the problems I had to deal with for a while, is I got out of a winning trade too early because I wanted to take the money off the table. I wanted to book the win, as opposed to let it run. So I violated my rules on the exit because I got out of winners too early. And that data is valid data in pile B. So I segregate the data into two piles. One is all valid data. That first pile is a measurement of my system and its performance because I stuck to all the rules and it's good data. Pile B is just as valuable, if not more valuable, because it's not a measurement of the performance of my system, but of the operator. And those lessons are very valuable to see. I need to improve on what aspect.
So pile B would contain not only rules broken, but also mistakes made, including execution errors?
Exactly. Then I capture the data, but I'm going to segregate it because it really wasn't a true measure of what is my system performance capable of.
I really like that. I think doing it that way has tremendous value.
So I literally set up my spreadsheet to do exactly that. Every trade I capture the data on, but it either goes into pile A or pile B. It can't go in both. And reviewing that, where it becomes valuable, is a process of reviewing it weekly or monthly to say, okay, what's my most often error? What do I need to work on? Am I improving versus the prior period, or is it getting worse?
And that's how traders improve, by identifying their weaknesses and then working to correct them and turn them into strengths. And a lot of people don't even acknowledge their mistakes or the rules they've broken or their weaknesses, and then they wonder why they don't improve.
You have to be extremely honest with yourself if you're really going to improve or change. I have 4 primary systems I trade. They're mostly trend following with the exception of the third one. RW3 means ride wave 3. It's a continuation pattern, basically. You could use indicators. You could just use price patterns. There's lots of ways to do it. Why wave 3? Well, it's almost impossible to ride wave 1 because you won't know it's wave 1 until after the fact. It's like picking the bottoms. That's impossible. You won't know it's a bottom until after the fact. Wave 2, you're starting to get a clue, but it's still iffy. Is wave 1 over, or is this wave 2, or is it reversing? You don't know. And then when you see the beginning of wave 3 just starting to reveal itself, now you've got enough data to kind of have a better odds. Maybe this is wave 3, and I even go to the degree of, I call it Goldilocks, where each of my triggers has a too early, too late, or just right. So if I think wave 3 is beginning, I'm not picking the bottom of it, but enough evidence is in to say I think it's beginning. This is my sweet spot. Go for it. Or, it's beginning, but it's given too much confirmation. I've kind of missed the sweet spot. Too late. I'm not going to chase it. The reward's not worth the risk. Or it's too early. Odds are low. I might, if I'm right, I get a bigger piece of it, but the odds are way too low. I'm going to wait for more confirmation. So Goldilocks, sweet spot, both on the exits too. The other systems, trendline breakout, support and resistance breakout, those are for either trending or horizontal markets, or a combination of those things. And then the fourth one, Omni, is something I can do with options. And we had an opportunity in December, I think December 23rd last year, that met my criteria. An Omni means I'm just putting 3 simultaneous positions on. I'm betting on up, down, and sideways. And the way this works is I have to make two of them are going to be losers. I have to keep them small enough so that the one winner pays for the other two and then some. In trending markets, I'm going to use those three systems primarily. Non-trending markets, you can see there's some overlap. I'll use those systems.
So speaking of strategy, what would you say your best performing strategy is, and why do you think it's so successful?
There's so much overlap between I showed you my 4 systems. In each one of those, there's a fair bit of overlap of a lot of similarities. So it's a little challenging to quantify it exactly that way to say which one's the best one.
Then let me rephrase. Why do you think all of your strategies as a whole are so successful?
I have a systematic approach where I do the same thing again and again and again. It's real boring. It's basically do this, rinse and repeat.
Is there anything that you do while you're trading that helps you keep your emotions in check? Or have you been doing this so long that you have evolved beyond that?
Now, I still have emotions every day, but I've been doing this so long, I've developed the skill to immediately recognize them and to not have them impact my trading decisions, but use them in a constructive way to say, oh, does this reveal an opportunity?
So let's jump into the charts and technical analysis. Why don't you share some of the stuff that you do?
Probably my favorite and most often used is the most basic of all technical analysis tools, trend lines. And probably everyone has heard about them, and probably a lot of people use them. But what we'd like to do here is first talk about how I draw them and what conditions cause me to at times have to redraw them and what my rules are for doing that. You need a consistent method, so rules are important to get there. So we're just going to use daily charts. I find that reading at the right edge of a chart is the most valuable skill to build as a trader. It's great to start by learning patterns. Their value is really understanding them thoroughly and having built skills to read the charts at the right edge to recognize when something may have happened that's of note. First, talk about some generalities with any tool, not just trend lines, but you'll find that the more confirmation you get from the charts, the fewer false signals you'll have. But it also has a trade-off of there typically is going to be more delay with that signal. And so we can interpret signals and indicators with an aggressive or conservative or intermediate approach. Aggressive generally will get much faster signals, can help you get into a trend or out of a trend quicker, but there's going to be a penalty of far more false signals. And that's the trade-off of an aggressive trigger method. A conservative method is going to be much slower because it's waiting for more confirmation from the chart that a trend has changed. So it's going to be a bit later on the entry and exit, but it's going to have far fewer false signals. And then we can come up with a compromise that's kind of between those two extremes, which is generally what I try to do is reduce some of the false signals, but not all of them. And the net effect is what's important of how we measure and compare the methods. When and where to draw trend lines. Let's just define it in black and white, where we're going to draw a straight line between 2 points. And I choose to do that in a way so that either underneath or above that line, 100% of all price activity resides for the time period we're studying. So a bullish trend line would be drawn between 2 lows where all the prices for the period we're studying are above that line. A bearish trend line we're going to draw between 2 highs, and prices remain below that line for the entire period we're studying. We have to do it in a way where that the slope of the line agrees with the trend. So bullish trend lines move uphill to the right and bearish downhill to the right. Pretty obvious, pretty basic, but we define them for a reason. When to draw them? Well, here's the rule I choose to use. I could draw them anytime I want as long as the most recent trendline drawing point occurs at least 3 periods prior to the current period. So if we're talking about daily charts in our example, it's going to be 3 days after a significant high or low was made that would give us one of those 2 points to draw the line. And doing so helps us reduce some of the noise. It may have a penalty of being 2 or 3 days late in some occasions, but it does reduce quite a few of the false signals. When price does violate the trend line, but later we see that it really has not reversed the trend, well, that's the whole purpose of drawing trend lines, is identifying the trend and identify when the trend has changed. So if we have violation of the trend line, but then the following periods it returns and continues the existing trend, then we wait 3 days before we redraw that revised trend line.
People define violates in different ways. Some will say 2 lower low closes below the trend line. Some will say if it just moves past it, even if it comes back, a high or a low. Or some might just say 1 close. How do you define violates?
Yeah, that's a great question. And all of those methods have work and have trade-offs. Back to the prior screen of aggressive versus conservative, waiting for 2 closes that consistently back-to-back violate the trend line is one way to confirm, well, it looks like a trend reversal, not something else. Ultimately, whatever your rules are, the most important part is stick to the same rules consistently.
How are you defining violates for your trading process?
We're going to look at examples, and I think that's the best way to answer the question because it's a great question. Ultimately, our objective is we want to confirm when the trend is reversed or not. And sometimes that takes a couple days to confirm that. And this 3-day rule kind of helps us do that. If the price penetrates that trend line but then resumes the trend, we wait 3 days to redraw that line. So this is our redraw rule. It forces us to kind of be a little patient. And now if it violates and then the next 3 days it continues to violate, well, we have more confirmation of a trend change. So that's what my methodology basically is. Again, this study's for educational reasons only. And in addition to reading the charts at the right edge and when to draw or redraw trend lines, we're also going to do simulated stock trades with each one of the triggers. I traded this pattern with options, and the stock trigger points are identical. When it's a good time to get in the stock or out of the stock per the trigger we're going to show, I'm actually doing options trade. But for educational reasons, I'm keeping this simple as if it's a stock trade because it's really the same triggers.
Well, that's great information because a lot of people who don't trade options may not realize that you're going to be responding to the same entry and exit triggers that you would for options as if it were a stock.
Exactly. Here's a second filter that helps with the noise. Any indicator is going to have false signals. So here's an additional rule that I've implemented. If the 20-day moving average is below the 50, and that's often the case if there's been a bearish trend for a while, then the price violation needs to be both above the bearish trend line and the 50-day moving average, because the 50-day is the higher of the two at this point in time. The second condition here is if the 20-day moving average is above the 50-day, my trigger relates to a violation of both being above the trend line and above the 20-day. So in this case, the 20-day is higher than 50. So whichever, for a bullish trigger, whichever is higher, the 20 or the 50, I need to be above that and the trend line for a trigger.
I really love how you consciously and aggressively filter signals out for noise. I think that's just fantastic, and it's not something that I see a lot of other traders doing.
Like anything, it's ultimately a compromise. There are going to be some signals that are later because of my rules, and I understand that, and I'm willing to give that up for the sake of having fewer false signals. I'm still going to have false signals, but instead of maybe 70% of them, maybe 30% of them. That's a good deal, and I give up something in exchange for that. And that's common you'll find in studying and implementing any technical types of conditions.
We were actually just talking about that in the chat room today, how trading is a constant trade-off or struggle to find balance between two opposing things, like risk control versus profit, that sort of thing.
Exactly, yeah, and there's 3 that are interlinked. Risk amount, the reward amount, and the probability. Those 3 are all interlinked where you do things to your system to try to improve one. Well, there's going to be a trade-off with the other 2. So you always have to look at the net effect.
I couldn't agree more, and I do think that's something that especially new traders overlook. They don't even really know to think about the interconnectedness between risk, reward, and probability.
It's great to do those studies, and that's how you find a comfortable compromise, is doing your studies, but realize it's a compromise between those things. So you always really have to look at the big picture or the net effect of those three variables. My trading style, 90% of my trades are the most active stocks and ETFs. I choose that intentionally, and a simple reason for that is I find a couple things to be true. In my experience, is they're a little more efficient, meaning there's so much depth to the markets, so many participants, that the slippage between the bid and ask is smaller. It's easy to get fills. It's a more efficient at the end of the day. And then secondly, the technical analysis patterns and behaviors, I feel, are a little bit more reliable the larger the market is and the more participants, because the mob psychology aspect tends to be more repeatable with a larger crowd.
As far as your stock candidates go, and you focusing in on the most active, you have a volume requirement or a market capitalization requirement that's more specific?
What I find more useful for me, because I trade options, is to actually look at the options activity. What's the daily volume with the options? What's the open interest? And ultimately, I'm looking for efficient markets. And that's 90+% of what I trade are the most efficient markets. And if there's lots of participants in the options market, generally there are a lot of participants in the underlying stock or ETF. And the way I look at that is I don't want the size of my position to be any more than 5% of the daily volume of that options contract. If I'm the majority of the market, then I'm kind of my own worst enemy.
Just to give those who are new to all this, what would be a minimum open interest or options volume that you would consider?
Options are kind of different because they're much more inconsistent about daily volume. You kind of have to look over a period. But if I see something that there's hundreds or thousands of contracts trading in a day, or the open interest is multiple thousands, then I don't have a problem with trading my 10, 20, 50, or 100 contracts. That's how I'm looking at it as an options trader. Now we're going to look at kind of the overall markets, what happened back in January. I think we all probably remember that the first trading day of January opened up with a pretty bearish tone, and it continued for 3 weeks. So we saw lots of trend line reversals and bearish trend lines for the month of January. That started reversing in February at various levels. I think everyone's heard of Amazon. It's certainly a pretty liquid stock. We're going to look at the charts to make all of our trading decisions. If I can define it clearly to another person and they come up with the exact same result, then I've clearly defined my rules. I'm trying to remove subjectivity intentionally.
I think one of the best things anybody can do when they're writing or starting to write out their rules is to hand it to a friend and see if that friend or colleague could duplicate the exact trade that you would make with those rules.
Just like with drawing trend lines, if I give you a definition, which I just did, on how to draw the trend line, then we both should be drawing the exact same line per those rules.
If we couldn't do it, or another person couldn't follow those rules, then we need to go back to the drawing board and further define our criteria.
There's a second test that I even find almost more valuable, is if I've defined the rules so clearly that they can be programmed. So, not that everyone here is a programmer, but if you either create custom indicators or trading systems, you have to be very clear to tell the computer what to do, and it comes back to very clear definitions that are repeatable for the methodology, and that's another good test of, are my definitions very clear and precise?
I found that if a trader sticks to the concept of if then, if this, then that, they can kind of mimic a mechanical system.
It gets very close, yes.
And still allows a little bit of discretionary wiggle room.
The bottom line is we're intentionally trying to make every decision based on just the facts. We have price, time, and volume, and that's pretty much all there is to technical analysis. To be able to do that, we need to stick precisely to our plan and our rules. Plans and rules have problems and may need to be fixed, but you'll never know what needs fixing unless you've stuck to your less than perfect plan for a period to then learn and find out how to fix it. Let's look at a chart of Amazon. You only know what you know at that point in time and be able to clearly make decisions based on that. And ultimately, you want to identify when your edge exists and does not exist, whatever your indicator is. Today, we're mainly looking at trend lines. And mastering the skill takes lots of practice, and that's as simple as that, whether it's sports or music or trading. Lots of practice.
It always surprises me how people think they can just jump into trading and become, a millionaire overnight without any practice, any knowledge, any skill. Trading is hard work.
And realize, unlike sports or music, where when you begin, you're not performing music at the high-end symphony level, okay, or you're not playing baseball at major league level, you're starting at the different leagues. Well, unlike music and sports, trading, there's one market, and you are in the same pool with the professionals. Take seriously the skills you need to learn and the discipline you need to learn, because the professionals have plenty of ways to try to shake the money loose out of the weaker hand, and they do. Here's a daily chart of Amazon, and we clearly see the bearish trend and an orange trend line. Several weeks later, February 29th, and we see the same trend line hasn't changed. It's not been violated. Our objective is not to pick tops and bottoms, because that's an impossible task. Our objective is to pick the high odds slice out of the middle of a trend. Moving on to March 1st, we now see a violation of that trend line, both during the day and at the close. But this is not a valid signal. Why? Because we're below the 50 and the 20. In this case, the 20-day moving average is the yellow, and the 50-day moving average is the blue, and they're both simple moving averages. One of our rules is when the 50 is above the 20, we need to break both the trend line and the 50, and we've only broken the trend line here. Now, it doesn't mean this isn't a signal, it just means we filtered this signal out. We're not taking the trade here. Now, the next day, the 2nd, we did not violate the 50, but boy, we came real close to just touching it, and this happens often as well. The 50's kind of acting like resistance. We don't know for sure what's going to happen the next day, but here we are 3 trading sessions later on the 7th of March. And you see, gee, that 50 moving average certainly held, didn't it? Now, has it been 3 days after that high? Well, let's try to redraw the line now from the 2 purple arrows. But there's a problem with this. You see how 2 days after that high, we kind of penetrated the trend line again without crossing the 50? So we really technically cannot draw the purple trend line yet, because it's not been 3 days after that yellow high. We need to wait 2 more days before we can redraw the trend line, okay? Mm-hmm. Here's 2 days later, the 9th of March, and now it's been 3 days after that yellow. So now we can redraw the purple trend line to that point. So now we're kind of ignoring the orange line, and now we're paying attention to the purple line as the active trend line. 2 days later, I see a violation of the new purple trend line, but not the 50. It's starting to change its behavior. Notice that the dip from the prior week didn't come down that far. In fact, the 20-day moving average almost acted like support of the dip the prior day or two. So now on the 14th, which is actually the next trading day, I think it's a Monday, we actually see an opportunity. I was prepared the prior day on the 11th to say we're getting close. So I'm watching this during the day on the 14th. As we're getting late in the day, I'm doing my math. And I'm saying, well, what if I get long here? And where would I want to put a stop? Well, I want my stop to be at least 2 times the average true range below my entry. And I also want it to be a bit extra below the most recent support. So let's assume, for the sake of discussion, again, this is just an educational example, if my current account value is $100,000 and I'm willing, per my trading plan, to risk no more than 2% of my current account value on any one position. In this case, $2,000 is the maximum I can risk per trade. It doesn't mean I only buy $2,000 of the shares. No, that means The distance between my entry and my stop is the loss per share multiplied by the number of shares. It has to fall at a number less than $2,000. If we were to go along at 572 with an initial stop at 544, then there's a $29 risk per share. Second step, divide that $29 into my $2,000 max risk rule, and I come up with 68.9 something. Well, I'm going to round down to 68 shares is my maximum position size to meet my rules. Now, I certainly can round down further, but I'm not allowed to go above that. Here's the most common mistake people make is, well, I can't make very much money with 68 shares. I want to trade 100 shares, so they're taking on far too much risk. Or they move their stop closer and take on too much risk, because moving the stop closer, the distance between the entry and the stop is really a probability control, and the number of shares traded is your risk dollar control. So the two are both very important. Now, if I buy 68 shares of Amazon, it's going to take over almost $39,000 of capital to do so. You should, and you may, if you're trading stock, need also a capital allocation rule within your trading plan. That rule might say, I choose to not put any more than 10% or 25% of my capital in any one trade. Capital allocation is a different rule. It's very important to consider in a plan.
No, a lot of people don't understand that there's money management, there's risk management, and there's trade management. When a new trader is beginning to develop their trading plan or their business plan, that they absolutely need to make sure they tackle those three categories.
Risk management's actually very easy to do once you fully understand it, but you really have to start there. I am so grateful that I learned early to keep the losses small. I survived through lots of mistakes to eventually learn to have consistent performance.
Well, keeping your losses small doesn't just protect your money, it protects your psychological capital as well.
That's almost the more valuable part of it, because you're going to be more able to make objective decisions when you're not going through feelings of remorse, regret, revenge, whatever. And I can go down the list. Oh man, I got to get my money back. And now you're no longer making objective decisions, and that's even more dangerous, and it compounds the mistakes.
It's definitely much more easier to be psychologically resilient when you're not down 50%.
Oh yeah, because of the geometric progression, you've got to make 100% to just break even.
Exactly.
So you don't want to go very far down that path of total losses. You first are defining your entry and your stop loss location. That's where you start. Don't think about profits yet. You got to think about losses first. Simple math to divide that and come up with my maximum number of shares. The important thing is we're sticking to our risk rules, because we're going to have winners, we're going to have losers. And, keeping those losses small and letting the winners run is what this chart reading exercise is all about. With understanding the risk and the position size, let's again look at our chart on the 14th. Our trigger is happening. I'm going to try to get in at this 572 area. The red line shows my stop location. It's a bit extra below the low of that day, and it's a little bit more than 2 ATRs below. And I was able to get a fill, and my entry actually was a few cents better at 571.43. So we buy the 68 shares at 571.43 with a stop at 544. 2 days later, we kind of briefly went under the trend line, but we've not hit my stop. We're kind of halfway there. I'm not freaking out. I'm just sticking to my stop. The most important thing is stick to my plan. Let's go the next day, the 18th. Now here it spent as much time above the trend line as it did below, but it's closing down. So I got 3 days in a row. Also notice that we're real close, or we just barely took out the prior low. It's not looking great. That's okay. Stick to the plan. Next day, it took me out. That's okay. As long as I stick to my plan, that's a good trade. This high that happened on the 16th or 17th, it's been 3 days since then, so I can redraw a new blue trend line at the blue arrow. Here's the summary of trade one. So we bought 68 shares. Our risk was actually 1904, which is less than the $2,000 max risk. There's our entry. We tied up 38,800 in capital. Our exit was stopped out at 543.96, a little bit below the 544. And so the loss was 1868 before commissions and fees. With commissions and fees, that's going to be another $20-$40 depending on your brokerage. But the important thing is the loss was no bigger than our $2,000 limit. So it met the rules. Congratulations, you stuck to your plan. Now we're on the 23rd of March. Now the 20 moving average crossed above the 50-day moving average 3 days prior, and we're kind of kissing the new trend line. We haven't violated both yet, but we're getting real close. So I'm getting prepared here. But what happens on the 24th? We now have both conditions met of being above the 20 and the trend line.
Do you have a consecutive loss limit, or do you limit how many times you allow yourself to re-enter a stock unsuccessfully?
No. I'll keep pounding away as long as I'm sticking to my rules. Now, if I violate my rules, that's a different issue. I may need to take a time out for that.
If you had, say, 3 or 4 consecutive failed trades in Amazon, hypothetically speaking, at some point would you stop and do some kind of a post-analysis, or would you just continue to try to enter when it sets up?
It's a great question, and I'm going to honestly answer it. If it's a trading system that I've very well proven out, and the market conditions have not done anything to violate it, and I've not broken my rules, I will continue to trade it.
That's outstanding.
Because I've had 7 losers in a row on the same instrument, but because I knew my system and I knew that that's possible. The odds are small of it happening, but it's very possible. And the criteria hadn't changed. I stuck to it. If you asked me the same question on a new system I'm evaluating, absolutely, I don't have the confidence or history with it, and I'm going to stop and look and reevaluate.
That's real discipline. When people talk about discipline in trading, they throw that word around a lot, and a lot of people don't actually take the time to define it. But to re-enter after 7 consecutive losses and continue to follow your plan in your system, that's discipline, and it's impressive.
It's not easy to do, but it's easier when you've stuck to your loss rules of not letting a loser get out of hand and any bigger than your max risk. It's the combination of those things and the confidence of a well-proven system. I, in essence, have been trading a very similar system with very minor changes for 10 years. I'm not going to change it on a whim because of one odd occurrence. Yes, surprises happen all the time. One surprise isn't enough to change a well-established plan or trading system. March 24th, we see the criteria met for our next trade. We're above the 20, and the 20 is above the 50, and we're above the trend line. We're prepared to get long. Here, I was watching it during the day, and my criteria was met, and about an hour and a half into the day, I actually got long. The important thing is we stick to our plan. Our account now is 98K because, well, we had a loss. So 1960 is the max risk. Our long entry, if it's at the 569 area, and I have an initial stop at the 535 area. And I've confirmed that 535 area both represents a point that's a bit beyond the most recent support and at least 2 times or more than 2 times the ATR. Then that's a risk of 34 per share. Divide that into the 1960 and I come up with 57.6. 57 shares is my max position size. So I'm looking at buying 57 shares at the 569 level. And that's going to take up over 32,000 of capital. Your capital allocation rules are very important. Stick to them, whatever they might be. Here's what that entry looks like after the close on the 23rd, and on the 24th we were able to enter. And we also noticed it's been 3 days since the March 21 lower low, so it's now time to draw a bullish trend line. The yellow arrow pointing to that low day, and the red line is the new trend line we draw because our criteria of 3 days has been met. So here we are a couple days later on the 29th. We kind of know right away that at least it's beginning to go our way. But you see the red line where the stop is. because I tend to be a momentum trader and I'm looking to catch trends and ride trends, if a trend is going my way and I've been in the position 1 week, which here we are, I have the choice to consider moving the stop for the first time from the initial stop. Trailing stops are very important. In fact, I probably spent more time studying trailing stops than anything else, because there is never a perfect example. It's always a trade-off, like we've been talking about. If I have it too tight, the noise kicks me out and the trend continues without me. My objective is to ride the trend as long as the trend is in existence as best I can. So if I make wider stops, then the initial entry is a smaller position, but I'm less likely to get kicked out unless there's truly a trend reversal.
So after about 7 days of the trade working in your favor, you'll move your stop to break even?
No, I'm going to move it to my chosen trailing stop method. And what I've added on the chart, in this chart, you'll see kind of a brown dashed line underneath price. That is a parabolic stop SAR. Parabolic SAR, or stop and reverse, is an indicator also developed by Wells Wilder back in the 70s. It's a way to pick an acceleration factor and a max acceleration factor of how rapidly or slowly the trailing stop follows price. After a great deal of study and evaluation, and I've been using for over a year now the 0.01 acceleration factor of parabolic SAR and a max 0.05 acceleration factor. And that's what you see on the screen with the dashed brown line. A week after I've been in the position, I have the choice to move my initial stop to not a break even, but the parabolic SAR. And in this case, it's not quite break even. It's maybe halfway there. That's okay. I used to make this mistake of being real anxious to move the stop to break even. Not all the time, but sometimes I get kicked out of great trades because I move the stop too early. And that's just the same a probability mistake as moving it too tight.
Is there a place where you would add to your position after you're up a certain percent in profit?
I choose not to, because as an options trader, I already have a fair bit of leverage due to the options contracts I'm using in trading. I look at it this way. I don't technically add to a position, but if I have all my criteria met as if it were a new position and its merits on its own standing would justify a new position, then yes, I could have a second position in the same underlying stock. A week or two later, the green arrow shows roughly where our entry was. Well, remember that day we had support at the 20-day moving average. The trend line was violated, and we're no longer using the red initial stop, but we're using the dashed brown line. And you can also see a dotted white or gray line. That's a 2 times ATR Keltner channel, just as a visual reference for me. And then there's also the 20-day moving average in yellow. Any of those could be a place for a trailing stop.
Regarding the Keltner channel, you prefer that over a Bollinger Band?
I wouldn't honestly say I prefer it. It's just calculated differently. Instead of using standard deviation as a measure of volatility, it's using the average true range as the measure of volatility. Each reacts a little differently. I have used both in the past. I think the ATR, I have slight preference only because I use it as part of my initial stop location calculation.
What's the maximum amount of ATR that you would use for a stop?
I have used 2.5. It's a trade-off. You're going to stay on board longer with a wider ATR trailing stop on a noisy stock than you would if with a tighter stop, trailing stop. The give back is when the trend is over, you're not going to be kicked out until a bit later. So it's a trade-off between some trends you ride longer and do better. Others, you're a little bit late getting off of the horse that's already turned around, and you're going to give back a little bit more. So there's pluses and minuses. You really ultimately have to study what's a reasonable compromise that you are comfortable with.
One thing I like to do is I like to start out with a tighter stop, and then as the trade moves in my favor, I try to give it more room. And then when it looks like the trade is starting to flash signs that the trade and trend might be coming to an end, then I'll start to tighten up my stops again. that works for me. Everybody's different.
And I'm sure there's examples that you have seen where that really helped and worked in your benefit. And there's probably other times where, no, I got out a little too early or whatever. And that's what you have to find in time for your style. And like I said, it's really a compromise that you have to become comfortable with.
I think of it kind of as stock is my employee. And when I first hire that employee, I first buy that stock, I don't really know them. I don't really trust them. I keep them on a short leash, and then they prove themselves to me.
They've earned their trustworthiness.
Through good performance, so I can be a little bit more lenient. And then there comes a time when that good employee starts to slack off again, and then I've got to get on him and tighten up the rules. So that's kind of how I run my stops.
And that's great. I've found that I never can take my eyes off the market because I don't trust it.
All trades end badly. All trades end badly.
I want to keep an eye on it. Even if I don't have a position on, I want to keep an eye on the game tables. Look at where we are here, April 28th. So we've been in this position for a month or more. If our trailing stop was at the 20-day moving average, we're kicked out a day or two ago. And now, even if I was stopped out, I still have a profitable trade. And I'm just sticking to my guns at that brown line, okay? So I'm not stopped out this day. Obviously, we had earnings event.
Zing!
And that's why I was sweating it a little bit, but I was not stopped out. And there's something very interesting about this gap day. It gave back very little of the gap. That's a bullish sign. What did I notice about the second day? A bullish sign of a stronger rally to higher highs.
That's a nice gap and go.
I have 2 days, both that are giving me bullish signals. The gap and give very little back day, and then the go day so it's a gap and go pattern.
Well, do you have rules about holding into earnings? I know some traders, they won't hold into earnings unless they have a certain profit margin, or some just have a standard process where they will sell half of their position and then keep the other half and roll the dice.
I do trade earnings events, but it's in a very different strategy based on options behavior and not the stock behavior. In this example, I'm just sticking to my plan.
Okay.
Another very interesting thing, you see the green line, the resistance that was defined the day after the earnings gap. We've come back and retested that a week later. I love this kind of pattern because that supply is soon to be consumed. So this is, to me, another bullish confirmation pattern. So I point that out because we're practicing chart reading at the right edge.
Carl, what impact does recent overhead supply have on your trades? Will you not enter a trade if you're aware of a lot of recent overhead supply or recent overhead resistance?
No, in fact, that's going to give me confirmation. On the same chart, if we look back in late December to the left of the chart, you'll see the orange and purple and blue arrows. That's where we drew the trend lines. Well, you also see kind of a gray line going across the entire screen at that 696 level, I believe it is.
Yes.
That's a place I'm keeping an eye on for potential resistance. I love support and resistance, but I don't use them as goals or targets. I use them as road signs. When you're traveling down the highway, where are you? Well, you look at a road sign to kind of tell you I'm 5 miles from my next exit. Support and resistance are simply markers along the road, and what becomes interesting to me is studying, do all the cars take this exit or not when we get there? I'm studying price behavior. In the short term, I'm also looking at the green line over the prior week. Both of those are areas of potential resistance, and I have confirmation by price respecting that green line on 2 different days.
Well, when it comes to risk reward, what kind of risk reward are you looking for before you enter a trade? And do you have a methodology for determining how much profit potential might exist in any given stock that you're going to enter?
Yes, and the way I look at it is a little different, but it's very practical and functional for me. Before I enter the trade, I will look at risk reward. I'm looking for a 3-to-1 ratio. I'm going to look back at price behavior to see, is it reasonable for us to get back to that level? On the screen that we're looking at here, if you see the orange arrow kind of to the left third of the screen, I think that's a high in late January or maybe January, early February, somewhere in that area.
Yes.
My risk is my entry to my stop. My reward is the entry to the next level of resistance. I'm going to take the most conservative prior resistance to do my 3-to-1 ratio only as a validation of, is it worth taking the trade? Once I decide to take the trade and I'm in the trade, I don't ignore those levels, but I'm not planning to exit there. I'm going to watch price behavior there, and based on price behavior, reveal the trend change or not, and then exit based on price behavior. Those prior levels are road signs that are telling me, hey, time to pay close attention to what's going on here. It's not a goal that when we get there, I get out. No, it's simply when we get in that neighborhood, I'm going to watch how price behaves. And indeed, in mid-April, it acted like resistance and continued to act like resistance. But then earnings happened, and what? We skipped right over it and beyond it.
You look at resistance as a flag that says, hey, it's time to pay a little bit more attention here to price and volume.
Yeah, this could be an interesting area to observe. I use the highway analogy, but it's kind of like, all right, we're getting close to our exit. Who's going to exit here? Is everyone bailing out because they know something of what's ahead, or only 10% of the cars getting off of this exit and 90% are continuing on the highway? So it's just a point to pay close attention to, that's all. I did use support as an example with placing our stops a bit beyond it. With our current chart of April 9th that we're looking at right now, we see resistance. It's not changing what we do, but we're observing. And here is what we just talked about in a slide.
Oh my gosh, I did it again. I'm so sorry.
And the green line is supply that the buyers are persistently consuming. We're looking for that to break. And indeed, the very next day, what happens? Not only did we break the resistance of the green line, but we also broke above the gray line. I did this for the sake of practicing chart reading, because if we go back to the prior chart, you'll see several messages that we kind of pointed on. It doesn't tell us or predict what the price is going to do, but it just reveals what's the attitude in the market. The buyers seem much more persistent than the sellers.
So when you exit, are you all out or do you scale out and take partial profits? And if so, where might you normally take them?
90% of my trades are pretty much all in, all out. I'll use my max risk rule and go all in and go all out.
Say you have a large winner and it's really run up and you've been following your rules and it's starting to get a little long in the tooth. Maybe it's encountering some resistance, or maybe it's just had a long, strong run. How much profit are you willing to give back before you exit? Are you always going to wait for your SAR to trigger you out, or is there at some point you're going to say, this has been a long, strong run, I'm seeing some signs of weakness in the price and volume action, and I'm only going to give back X% of profit?
It's a great question. And I struggled with that for a long time. One of my problems was I didn't like giving back anything. It took me a long time to learn to have a loose grip on things because it was counterintuitive. I put this under ride your winners, meaning stick to your plan. I've already gone through the process and analysis to make a reasonable compromise between the too tight, too loose, and just right for where my trailing stop is. I am sticking to my plan. Now, as an options trader, I have a lot more strategies I could use. I have a lot of opportunities to hedge, to protect my position, or to sell some premium. If I think it's going to be horizontal for a way, I can put different positions on that profit from a horizontal, non-trending market. I will look at each one of those opportunities as having merits on their own, and I trade actually 4 different systems. And each one has its own set of rules, and each one has strengths and weaknesses that make them the better player to put on the field in certain market conditions.
When you look at your biggest, best winners, is there a commonality between them?
From a risk management, I have to treat them all the same because you don't know which one is a winner or loser until afterwards. Right. Long after the trend is over and my trade is over, I can do a post-analysis, and this is something I do on a monthly basis. where I'll look at the trade to say, all right, if I captured 50% of the overall move, if theoretically I got in at the bottom and out at the top, maybe it was a $50 move. And if I got $25 or 50% of that, a nice bite out of the middle, that was an A trade. If I got less than that, I'm going to grade it a B or a C trade. If I got more than that, I can chuck it up to say, sometimes you're lucky. But the warning flags go up. You say, is it luck, or was I not following my plan, or was I chasing something and got lucky? The most important question for me is, did I stick to my plan? I literally segregate the performance data between the groups of trades that followed 100% my plan from those trades that failed at any one or more levels.
I really like that approach. It's kind of a perfect segue for my next question, which is, what one or two mistakes or events are responsible for your biggest losers when you go back and look at post-analysis? For example, a gap down on earnings, something like that, or executing the trade incorrectly or something like that.
I will typically have, on average, one trade a year that goes against me, like gaps overnight, and goes against me hard. The valuable benefits of trading options is options position has a hard limit of it cannot lose a penny more than my predetermined amount, even if that stock went to zero overnight. So I generally do not have any big losers, though yes, they went against me. I will have generally at least one trade a year that is bigger than a 1R loss. And that's the nature of trading. When I analyze a year's worth of trades and look at just all the losing trades, that the average loss between the big and the small losers is about a 0.8 R. So a negative 0.8 R is well within my risk rules, and I don't have a problem. I don't stay awake at night if one gaps against me overnight. Both because I have a hedge with the form of options, and secondly is, even though those options might lose more than 1R of my risk rule, that's okay, because I'll be unlucky once or twice a year. The converse is also true. I'll have one trade a year, maybe two, or it just exploded in my favor. With options, I could easily have 1,000% return on one trade.
Don't you love it?
The thing is, cutting the losers and letting the winners run. So even the outliers, the black swans, when they go against me, that loss doesn't get bigger than between 1R and 2R. Likewise, the one big winner, I'm capturing most of it when I'm lucky. So the two more than make up for each other.
Well, one of the benefits that options most traders probably haven't considered is that you're protected against black swan events.
The market could go to zero, and I cannot lose more than X dollars, which I could calculate in advance before I even put the position on. And it's very effective at accomplishing those two goals of keeping the losers small and letting the winners run. Okay, so we looked at the pop where we broke above two prior resistance levels, the green over the prior week and the gray from late December. Here we are, the end of the month, and we see that, well, it advanced for 3 days, and then we pulled back for 3 days. You see how the green resistance that held for a week after earnings almost acts like support 8-9 days ago. We continue to see higher highs and higher lows, and that's my definition of a bull trend. And our job day to day is just move the stop. I don't move my stops more than once a day. I don't have to move them every day. And I generally do that after the day closes. June 17th, I get stopped out. Well, you see, the market's been mostly horizontal for the last couple weeks, and we had a low that stopped me out. If I was using the 20-day moving average in yellow, I would have been stopped out 3 or 4 days earlier. So this ends our second trade. If we had continued on, the 50-day would have taken us out a week later. The 20-day would have taken us out a week earlier. We stick to our plan. That's the important thing. So let's summarize trade 2. We did 57 shares. Our risk was $19.39. Made a nice little $7,500 on this before commissions. This is a plus 3.8R trade. So we have one winner and one loser. The first one was a loser when we were stopped out a week later at our initial stop. And then the second one was quite a nice winner.
One of the things I like most about this trade is that the winning trade was the re-entry, because there are so many amateurs and so many beginners that if they get kicked out of a stop or have a losing trade in a particular stock, they won't re-enter. And oftentimes your second entry is the one that makes you the big money.
Yeah, and it can be damaging in multiple ways because, and this happened when traders trade a new system. They're trying to follow the system, they get a loser. They try to follow it again, they get a loser. Oh, this system's no good. They throw it out after 2 or 3 tries. Well, if you really study the system, getting 3 or 4 losers in a row is very possible. You have to stick it out for maybe 10, 20 trades to even find out what's more typical. But most people don't. I was one of them early on, and it's tough to stick it out. That's why trading small is really important. In fact, my 2% risk rule, I would dial it down to 1% or less when I'm trading a new system. We can see that 3 days after that low was made, which is almost 2 weeks after we were stopped out, price moves back above the 20-day moving average. And the trend line support, the red line, has not been violated. And we were able to redraw that the prior day because we were 3 days after the event. At the yellow arrow, price breaking above both the 20-day moving average and a parabolic SAR flipping. We also see kind of a V pattern. Where it becomes interesting is on the neckline of that V is clearly broken, as are the highs for the prior 2 or 3 weeks. So July 1st is a very strong, significant day on multiple levels for those reasons. Because we're above the 20, we have a valid opportunity to re-enter here. But if we just stick to our original rules, don't even bother calling it a re-entry. Just say, are my rules met? Yes, I have a valid entry point here. So trade 3, if I enter at 721 with a stop at 678, that defines a $43 loss per share. Divided into my $2,100 risk, shows that 49 shares is my max position size for this criteria. Here we are 11 days, and now we are in this trade for a full week, so we are allowed to begin to move our stops, which we do at the parabolic. Here we are on the 19th of July. Here we are on the 1st of August. We've taken out the highs of July, so I still see on this chart higher highs and higher lows. And we're just riding along, moving our stops once a day per the parabolic. As of this recording, we've not been kicked out of this trade.
Do you trade stocks independently of market conditions, or do you have rules about you won't go long if the market's in a downtrend?
No, I don't have any rules of that nature, of like a correlation between broad market. But I do use a top-down analysis to find candidates. So for example, over the last year or two, during 2015, we saw the sector of the metals. U.S. steel was a very bearish trend all of 2015. I will do sector trades, and I do longer term trades, and I do occasionally do some stock trades in my retirement account, where they're more of a longer term and more driven by weekly trades, but it's really the same methodology we're covering here today.
But you have no problem going long in a stock that looks strong and meets your requirements, even if the market's down.
If a stock is going opposite of what the trend in the market is, I don't have a problem trading it, but I will confirm that it's respecting its sector. So for example, U.S. steel, copper, aluminum, all the metals, and in the heavy construction side of things, Caterpillar, Cummins, over the last prior couple years, were all very bearish as a sector. So because that sector was bearish in a bullish context, I don't have a problem with that. I don't have a problem going opposite of the overall markets. So let's finish up with a summary of these 3 trades. The third one is still an open trade as of this time. With the first trade, we had a 1R loss. With the second trade, we had a 3.8R win. If your win to loss ratio is 50-50, which is about what mine is, when your winners are bigger than your losers, you're still net ahead of the game. And that's the realistic example that we've given here. And I know that we've covered a lot of chart reading aspects, but I think this is an example of a very effective way to learn those skills by practice.
Charts are the best way to learn anything, and the more you can look at charts, the more you can see how other people do charts, the quicker you're going to learn. It's going to accelerate your learning all around.
And in the stock examples, these trades required $39,000 per position in a $100,000 account. That may not be acceptable to a lot of people in terms of having a highly concentrated portfolio. And that I respect that, and that's a very important decision to make in your trading plan. Fortunately, being with options, I have far less at risk and far less capital tied up because I am using the leverage of options.
Well, some growth traders have no problem putting 25 to 50 to even 100% into one position if it's working for them. And then I know other traders, 10% tops, the 10 positions, 10% each, non-correlated.
Yes, and those are very important rules to determine regardless of what instruments you're trading. Ultimately, I look at those kinds of portfolio management decisions kind of like a coach. I need the performers on the field, and the guys that aren't performing I put on the bench. And portfolio management is very much that type of set of decisions.
That's a great analogy. I have a quick question about your charts and some of the indicators and oscillators that you use. We know that you use the parabolic SAR and the Keltner channel and moving averages. I also noticed on your chart you had a MACD and volume, and I was wondering to what extent do you use those?
I honestly really don't.
So you don't really give volume much weight when you're looking at a chart?
Not really. The events where volume really pops generally are very understood and explained because of earnings events or things like the end of a quarter. I do keep volume on my screen. I don't want to ignore it, but it's really not a part of my trading rules. I don't really use it in any decisions. The ATR, the other pair of studies you see on my screens, I do use, and I have two of them. I have a 1 period and I have a 14 period. I like having those on my screen because I can just hover my cursor over a date and the screen shows me those numbers. Having ATR on my screen is just a convenience, or I don't have to do too much math. It's kind of doing it for me to say and where the volatility is or isn't. Now let's take a look at some actual examples of doing the same trade two different ways. I think the best way to understand the pros and cons of trading options is let's do a comparison. We're going to do an example of a trade in Lockheed Martin that lasted about 1 week, and we're going to compare doing it with stock versus with options. Here's the chart, just so you see where our long entry is on the stock trade and where the initial stop location is. And then this is an important screen because it captures the options quote screen at this date and time on January 6th. And this is our reference entry point in time. So we're going to behave as if we did two trades simultaneous at this moment in time. One is buying the stock, and we're going to buy 260 shares at $146.89. And that's the current ask. So we would be filled pretty much immediately with this kind of order. Now on the screen, you're going to see the strikes listed down the middle from $100 to $195. And these are for the January 2014 series, which obviously has long since expired. But at the moment in time that this screen was captured, there was 11 days before expiration. If you look at the Jan 14 blue column, about a quarter of the way down on the screen, you'll see Jan 14 and the number 11 inside parentheses. That indicates that this series, the Jan 14 series, has 11 days before they expire. We're going to buy, in this example, the 145 strike calls, and we're going to pay $2.95 for them, and we're going to buy 4 contracts. Now with options, each one of these call contracts controls 100 shares of the underlying, so it really doesn't cost $2.95 per contract. It costs $2.95 per share. Each contract costs $295, and 4 of those cost a little less than $1,200. On the exit a week later, here's what the chart looked like. And again, our initial stop is still drawn in red. And here's an almost identical screenshot from a week later on Jan 13. Capturing the screen is a useful way to compare apples to apples, as what we're going to accomplish here. This is our exit day. So we're selling our 260 shares a week later, and we're being paid $153.84. That's the current bid. Likewise, the call contracts that we bought a week earlier, we're going to sell them for $8.70 a share. By capturing these two screen captures, one representing the moment in time of entry and the other one, this one, representing the moment in time on exit, we're doing a comparison of two trades that were precisely done entering the same time, exiting the same time. Again, trying to make them as fair of a comparison as possible.
So if I bought the stock and you bought the options, here's how it would turn out.
Right. Where does the 260 shares come from? If I were to buy 4 call contracts, that would cost me just under $1,200, which was my risk at the time. Those contracts I looked at buying were the Jan 145 calls, and those had a delta of 65. Let's go back to the prior screen. Okay, so this was our entry options chain quote page. And on the left of the call options columns, you'll see a 0.65 under the delta column. That's where the number comes from. So we use that 0.65 delta times 4 contracts, each that control 100 shares. So 4 times 100 times 0.65 equals 260. So these 4 contracts look and feel and behave like 260 shares of stock. Our risk rules, as we mentioned, were no more than $1,200 per trade, and both of them meet this. So we've intentionally tried to size these two trades as fair and equivalent as possible. The stock trade was an entry at 146.89 with a stop at 142, and that represented a $4.61 loss per share, or times 260 shares, an $11.98 loss, which is satisfying our risk rule of less than $1,200. Likewise, the 4 options contracts we bought cost us $11.80, and if we lost 100% of what we paid for those options, we would continue to meet our risk rule. Slippage and transaction cost. We have to kind of define this. Philosophically, it's as if a millisecond after you were filled on entering that position, you decide to immediately exit the position. So you're going to lose a pair of commissions to get in and get out. You're going to lose the equivalent of the bid-ask spread to get out. If you got in and got out in a millisecond of each other, theoretically, that would be a losing trade because of those costs. Slippage cost is the combination of your commissions, any exchange fees if appropriate, and these bid-ask spreads that we just mentioned. Those 3 pieces add up to the total cost of doing the transaction. Now let's look at the stock trade. Our entry, there was a bid-ask spread, and their exit was a bid-ask spread. Get in, we're going to pay the offer, and to get out, we're going to sell to the bid. We can do a hypothetical analysis and pick a theoretical midpoint between each of the bid and offers. Between the entry and exit, there's a theoretical gross P&L of $6.99 per share. That's a theoretical as if there was no slippage. I'm sorry, but that does not happen in the real world, but we're using this as a comparison gauge. The real actual trade is $6.95 of profit between the entry and exit per share. What that means is there's about 4 cents of total slippage between the theoretical and the actual. Likewise, 260 shares would require over $38,000 of capital. Total net position deltas is 260. It acts like 260 shares of stock because it is 260 shares of stock. And let's total the transaction costs for this stock trade. So we had a commission. Now I was using my current commissions. You were going to have something different. Totaled between the commissions, fees, and the bid-ask spread, a total of $26.38. That's for the round trip of both the entry and the exit transactions. So the theoretical P&L of 1817 less these costs is an actual P&L of 1791 after commissions and fees. That represents about a 1.5% cost for the trade. Again, capital required was over $38,000. Let's look at the same trade but done with options. And in order to make them equivalent and meet our rules will have the same net position deltas. I showed you that computation earlier where 4 contracts allowed us to have the same 260 equivalent position deltas. Now with the options trade, we used the same process and we filled in the bid and offers of the options contract. That was the Jan 145 strike calls. And the midpoint is the theoretical value. So the theoretical P&L per share is $6, but the actual is $5.75. Why? Because we have 25 cents of slippage. However, the capital required for the trade was $1,180, much less than the stock trade. But they both have the same equivalent deltas. The transaction costs for the options trades, the entry and the exit, add up to $117, almost $118. You see that it was an $8.99 commissions, but the slippage was $100, and that's the 25 cents times 4 contracts times 100 shares per contract.
And that's a lot higher than most stock traders are used to.
Exactly. This is why we're studying slippage costs, because it's significant. The theoretical options trade was a $2,400 gain. The actual options trade is a $2,282 gain. A 4.9% cost to play, but only $1,180 capital required. So this is where we summarize all of this information. With the stock versus the options trade, you see the size of the position, the number of net deltas that each position represented, the total round-trip costs, and this is the big difference here. The stock trade, it was a little over $26, but the options trade, it was almost $118. That's like 4.5 times more expensive. Our risk rules were met in both examples, and both had the same equivalent deltas, so it was a fair comparison. Now, because the slippage is so significant, another way to look at that and take that into account is the stock had to move in my favor by at least 10 cents to hit the break-even point because of the slippage on the stock trade. However, on the options trade, the underlying stock had to move 30 cents at least in order to hit a break-even point, meaning I can get in, I can get out, and I break even because the underlying had to move that by that amount to make up for the transaction cost. The other big difference is the capital required. The options trade required $1,180. The stock trade required $38,191.
That's a significant difference.
Yes, so you see that although there's a huge leverage with how much capital is tied up, that leverage cost $118 to implement versus $26. The return on capital is significant because the capital required is significant. So again, we intentionally tried to make these two trades as identical as possible so we can highlight the pros and cons, the significant differences between the two trades.
So one, for stocks, you risked over $38,000 and you only made a reward of about 4.5%, but you made 193% with the option. That's pretty big.
The shortest possible answer of the question why I trade options. This is why. It gives me leverage, but the lesson here is that leverage is not free.
Because of the increased cost of slippage.
Exactly.
But on the other hand, it's a completely defined risk. You can only lose the amount of the option, no more. Where if you have a stock and there's a scandal overnight, it could gap down 20, 30, 40%.
Yeah. What if instead of trading in the $146 or $150 range, that news came out and the $150 stock goes to zero? That would be probably beyond a black swan, but my options cannot lose more than the $11.80 I risked. So in reality, we could have a gap down of, let's say, 10% of the stock. That certainly has happened with bad news. So if the $150 stock became $135, $140 stock, again, I could lose a whole lot more than the $1,200 I initially risked, and my stop order might be triggered well below where I placed it in that gap overnight scenario. A big advantage of options is very accurate risk management, where it doesn't matter what black swans fly at you. You cannot lose a penny more than the 1180. But it's not free. Okay, as we saw, the slippage was like 5.5 times bigger. There are two other dimensions about options that I would be remiss to not mention. One is theta decay, meaning that over time, if nothing happens, the value is going to dwindle away over time. Likewise, what strike you select and the volatility and behavior of the underlying stock affect dramatically the probabilities. And the probabilities of those options having value or not are dramatically impacted their price and value at any time as well. So learning options involves several more aspects and respecting and managing them as well. To summarize, we went through a quick example of the comparison between a stock trade and an options trade. And indeed, it was a nice winning trade. Remember, if you're going to compare things, to do it for losing trades as well, or trades that went sideways for a while, because they will have different results. And you need to understand the pros and cons, and comparing them like I did is a very useful process. Ultimately, our goal is consistency. Heather, you and I talked about that kind of at the beginning. In our experience, had to get to a point to kind of let go of the chasing big profits and just focus on a consistent performance.
Absolutely. I think that when you focus on trading well and on trading process instead of the money, your performance will improve.
Exactly. I struggled myself for a long time trying to figure out how to do this, and I finally stopped and went back and wrote my own trading plan. In doing so, I had some real valuable lessons, many of which we've touched on already. And I ended up not only incorporating those into my trading plan, but I had so many people asking me for help, and having been down that path, I ended up doing the last thing I ever imagined I would do, but put these key lessons that really made the big difference in my performance into kind of a lesson plan, which later kind of became a 2-day seminar that really taught the things that I felt were the most important lessons I had to learn the hard way. And unfortunately, the many seminars I went to and many books I read at the beginning of my quest really did not address these aspects. These are the aspects we've been talking about today. There's also a lot of free material at my website as well too, with some useful links and tools, links to free educational material. But I do provide on a very limited basis one-on-one coaching, and I do have my workshop that I give on occasion, or I record it if you're interested. I also have a Yahoo group called Objective Traders. You're welcome to join that if you'd like. And I do a weekly post or email through that group of just simply my observations looking at the markets. I do that once each weekend. And it's just a useful tool for people who are interested in learning their chart reading skills and strengthening those skills. That's all free material if you are interested.
Don't you also have a meetup group dedicated to options, Carl?
Yes, I have a meetup group. No, I wouldn't really say we're dedicated to options. It's really open to anyone that's seriously interested in the markets. And we meet in Paulsville, Washington once a month, usually on the second Monday each month.
Well, what's that meetup called so people can find you?
It's not a meetup. It's this Yahoo group we're looking at right here.
Oh, it is. Okay.
Objective Traders.
Okay.
And that will tell you the information of when and where we meet. You're welcome to join us. It's all free material, and it's just people with like mind wanting to learn.
What would you say one or two of the most common mistakes are that new traders make?
Probably at the top of the list would be trading too big of a size, taking on too much risk. This ties very much into the tendency to focus on wanting to make money quick. And it doesn't work that way. In fact, the markets are almost very efficiently designed to extract money from those weak hands. What we talked about already with keeping your losers small is so important so you can survive to learn. Don't be in a hurry to make money. That's probably the most dangerous and often found mistake, where people may not realize that they're taking on far too much risk. One of the worst things I've seen happen when someone begins trading, and it doesn't matter whether it's options or stocks or whatever it is they're lucky with the first 5 trades or something and have made money each time. They confuse luck for skill. Trying to teach risk management or objective methods is impossible because based on the limited experience, a very different belief of what reality is. The best thing to happen actually is to lose your first few trades so you realize there is more to learn.
What do you think most of your winners have in common, especially in terms of any kind of trade management?
When I look at the distribution of winners, because there's small winners, there's medium winners, and there's a few big winners. Pretty much every year I'll have one extra lucky trade and one extra unlucky trade. And that one trade can really skew the average.
What do you think most of your winners have in common? Is it anything that you've done or you've seen or you've identified?
Sticking to my plan on the exit rules has been the most important, and that's the second half of that golden rule we talked about, letting your winners run. So I do a lot of work post-analysis in what's the more or most effective exit methods and trailing stop methods. Over the years I've realized mathematically to not keep such a tight grip and to get a little looser on those things. I've used a lot of different methods, but generally, when I've allowed room for the noise, I'll have several very big winners because of it, that otherwise I would have been stopped out far earlier on. When I keep a tight grip, there's less give back, but then I may miss out on the next move that's even bigger. There is no perfect exit. Every exit strategy has pros and cons. The remarkable thing is realizing the counterintuitive nature of when the trend has revealed itself and has revealed strength in its nature is to not have such a tight grip on it or narrow trailing stops.
You know, that's funny you say that, because one thing I like to do is I like to start out with a tight initial stop. Then once the trade starts to progress and is doing well, I'll loosen that stop up so I can catch the bulk of the run. And then when it looks like the tempo or the momentum, or I see a definitive sell signal start to flash, then I'll tighten my stop back up again. It actually kind of looks like a bell curve.
Yeah. Making any adjustment like that to a system, the important thing is to realize there's both pros and cons to any adjustment. I might have one or two bigger winners because I didn't get out of them too early, but then again, on some of the ones that were medium winners, I give back a little bit more. So it works both ways. When I loosen my grip, my process is a little different. You saw how statistically my average holding period is about 5 days. Generally, I stick to my initial stop for a full week before I start engaging the trailing stop.
I think what's important is that you have a repeatable process.
Right, and because I'll have a lot of trades that end up being winners, but they might have a couple more retests of support before they really break out. And where I got in was in that neighborhood. My initial stop needs to be wider to allow for the volatility of the price. And if I've done that, it can do a couple more retests before it takes out, and I'm still on board. If I have my stops too tight, I'm kicked out, and I either have to get back in, I may or may not. And it's counterintuitive to think, well, isn't it more risky to have wider stops? Wrong. Absolutely not. You adjust your position size so it could be the exact same dollar risk, but a different probability.
I agree. I know some traders that actually do a risk of 3 for a reward of 1, and they're very successful future traders. I think there's many ways to make money in the market. What's important is to be consistent, to have a process, to have a plan, and to make sure that it's repeatable and it fits your psychology and your personality. Trading can be really stressful at times, and it requires a lot of intense mental concentration, especially when you do it for a living. So I was wondering, what activities do you like to do to decompress and keep your life balanced?
That's a great question. I try to get up and physically move around. I mean, sitting for a long time, staring at one or more screens for a long time is taxing physically on your body. So I try to get up and take lots of breaks. We have a couple dogs that I play frisbee with. We have a beautiful area that we live in. I'll take walks, ride the bike.
I happen to know you like to play the bass.
You happen to know correctly. Is
I remember a jam session with Ed Sakota not that long ago.
Yeah, that was a lot of fun, and I enjoyed spending a little time with Ed and playing some music with Ed. And music's a great therapy, whether you're just performing for yourself or with others. That is one of the most important therapies for me, and I use that daily. Knowing yourself is real important, and some useful things that I did many years ago were take some psychology tests. I forget the names of the tests, they're pretty standardized, but basically evaluate your different sensory skills and help you understand, are you giving more weight to your listening or to your visual, what you see, or what you feel?
The different modalities, the different sensory
Yes,
modalities.
and it's certainly no surprise, and as a musician, that my listening is my higher priority, higher weighted sense. So I take that into account and design and locate my trading room away from all the distractions and interruptions as much as possible. I also would program alerts into TradeStation or other tools. I only have one set of eyes, and whether I'm trading with one screen or 10 screens, you can only look at one thing at a time, and you can get sensory overload very easily. When I was a day trader of futures, I had 10 screens going all the time. I used audible alerts so that when a certain market condition was met, a certain noise got played. And I collected sounds from movies I enjoyed or sound effects from cartoons, any random thing. But each noise only would happen if a unique condition in the market existed.
I thought I was the only one who did that.
So I could actually be 20 feet away from my screens and not even looking at anything and hear a particular sound and know immediately what event in the market just occurred.
I programmed Ninja Trader to do the same thing. I had special sounds for certain things. But that really is a testament to that you know yourself well and you're playing into your strengths.
Reading about aspects like that is one thing. That's kind of where you start, but how do you apply it? When I come across some valuable bit of wisdom or learn it from another fellow trader or a book I read, then I try to find ways to apply it, and that's where its real value comes into play.
I think you've definitely given listeners a lot to think about and a lot of great examples, and you've shown them many different ways to approach the markets and approach their stocks.
It works for me because it's built around my beliefs. And that's something we shared back at the beginning of I've actually sat down and written what I believe and what I assume about market behavior. And I've built my trading methodology around it. I encourage each listener make a similar effort to understand your own strengths and weaknesses, confirm what you believe about the markets and try to objectively observe them and build your own set of beliefs, and upon which you can build your own trading system. You're going to be able to be successful at trading a system that fits you. It's going to be very difficult to trade somebody else's system, but sometimes that's where you start learning out.
It's a journey that all consistently profitable traders have to go through.
Yes, and there's plenty of examples in Jack Schwagert's books.
We usually have a lot of newer traders who like to listen to the show, and I was wondering, what do you consider maybe 2 or 3 of the most important trading books you've read that you think new traders might enjoy, or traders who are just trying to improve?
I do have a recommended reading list posted at my website, and 5 or 6 different categories. I've flagged those books in each category that I felt were the most valuable or recommended to read more than once.
Do you have any 2 or 3 personal favorites that you've really enjoyed that stand out?
Probably Mark Douglas, Trading in the Zone, is one of them up there. I very much enjoyed Reminiscence of a Stock Operator because it reveals how human nature generally has not changed much over the past 100 years or more. I do a lot of reading. I'm constantly reading new books that come out. What becomes apparent after not too long is different traders' experiences are very similar to yours, though they may use different terminology or time frames.
Well, I know I'm going to be going to your website to check out your reading list. I'm always looking for great books to read. Let me ask you, do you have any favorite traders? And if you do, what do you like about them so much? I'll give you an example. One of mine is I really like Jesse Stein because he is not afraid to think outside of the box.
Oh, good question. There's a number of traders that I've had the pleasure of meeting and or getting to know. One that comes to mind is Linda Raschke. She was also one of the market wizards in Schweigert's book. I was amazed when she shared with me her trading style of how similar it was to mine. You know, it's kind of like, it's real satisfying to realize that maybe I stumbled across it a different way, but we ended up almost in this very similar destination. Those kinds of things are very rewarding.
What would you say have been the most important lessons you've learned as a trader that have helped you personally improve your trading?
Learning the lesson to let go of chasing profits and focus on consistency. That was a huge change in my approach, and it affected almost everything I was doing.
Well, how do you define discipline?
Doing what you intended to do on a consistent basis.
That's a great definition. So one of the last few questions I have for you is, what 2 or 3 pieces of advice would you give new traders wanting to improve their results, especially anything for new traders just starting out?
Not being in a hurry to actually trade.
Would you recommend paper trading?
Paper trading has both some pros and cons to it. When I started paper trading futures, I did amazingly well. And as soon as it was real money, everything changed. So you're not going to learn the behavioral aspects of trading unless it's real money. Don't be in a hurry to trade. Take as much time as you can to really study the markets. You kind of have to take a big approach and study a lot of different aspects to find something that appeals to you. What instruments to trade, what kind of time frame. Learn from others, but don't try to trade like others. You're going to find you have different beliefs, and you're going to eventually have to either change something you learned from somebody else or develop your own. Setting some goals and being persistent to work towards them is really how you achieve almost any goal in life.
Well, you know, I've always felt like it's not the goals that are so important. It's who we become as we strive to achieve them.
Yes, it's the journey that makes our character and develops our steel. Or we change our beliefs along the way, like some of the examples we've earlier spoken about. And it's kind of very much about the journey versus the destination.
Well, Carl, it's been great having you on the show. I appreciate it so much. We've had a lot of difficulty getting our schedule synced so we could sit down and talk, and then we also had to overcome a multitude of technical difficulties. And I appreciate your patience, and I am so grateful that you are willing to come on the show and share your experience with others.
Well, thank you for the opportunity to do that, Heather. I'm glad to have met you several years ago and have had a few occasions to share our thoughts and talk shop. It's great to meet and get to know other traders and learn from each other.
It's been a lot of fun.
Thank you again. I really enjoyed it.
Okay, see you in the chat room.
Take care.
A very special thanks to our guests for being on our show. It's been a lot of fun. Learn more about trading at Tacoma IBD Meetup Group, where it's always free and it's always about becoming better traders. Thanks for joining us on Stock Talk Happy Hour. Good fills, everyone.